Mike, so first of all, you heard the numbers on this auction, this 2-year auction today. Did it come in line with your estimates?
Well, it sounds like it was a mixed auction as far as the process itself, with a slight tail, low indirect bidder participation rate, but a very strong bid-to-cover ratio yet again. That number of 3.1 means that there was over 130 bids put in for the $44 billion that the Treasury was offering. So at these yield levels, that was very strong participation from clients, from investors. And it means that at the front end of the curve, the Treasury can continue to issue just about as much as it wants to issue, just as it did this time last year. Bill rates are trading negative on some occasions, which, again, is just an indication that there is this wall of cash to be put to work in the front end of the Treasury market, and that includes the 2-year. We're a little bit more concerned about what happens to the 7-year auction later this week. That's a sector of the Treasury curve that the Fed had supported very strongly in its purchase program that it just completed, that $300 billion purchase program. So that 7-year auction, which comes just a day before Thanksgiving, when the market is usually quite illiquid, has us a bit concerned.
Well, let's get back to the 2-year for just a minute, and also some of the other recent auctions that we have seen where demand has also been strong. As you say, the yields here are extraordinarily low. But what's going to change here, I mean, beyond the 7-year auction, what's going to change investor appetite to make it less strong, or is it going to change?
Well, into year end, we actually don't expect much to change at all. There is this wall of cash that will continue to get put to work. We don't think that yields represent fundamentals right now, and we do expect yields to be heading higher as we move into next year. But for now, as investors basically shut down for the year, we don't think yields are heading very far from current levels. Investors right now are in a risk reduction mode where they either have or haven't had a good year. Most have had a good year and just don't want to take on a whole lot of new risk until we get to 2010.
Hey, Mike, you talked about the negative bill yields from last year. Also, we see the auction coming off at one of the lowest levels, almost lower than what we had last year exactly. Well, that was a deflationary fear scenario, and you're talking about increased rates going forward or down the road. So what are you seeing? What about the deflationary trade?
Sure. So, much different from last year. Last year's trade was about just pure fear of what could happen, a second Great Depression, as well as deflation concerns. Those deflation concerns are pretty much off the table right now, as core inflation data that we've seen just doesn't support that view whatsoever. Core CPI just came in at 1.7 year over year. That's up from 1.4% year over year just a couple months, or 1.5% year over year just a couple months ago. Investors have been coming into the TIPS market because of concerns over medium-term inflation risks. Again, not over the next year or two, but what could happen if the Fed leaves this monetary stimulus policy in place a bit too long and causes inflation. So right now, that's a concern that's been growing on investors' mind, even as current inflation data remains relatively soft.
Mike, I got to ask you about the corporate bond market as well, because obviously there's a big appetite for corporate bonds also. I mean, and obviously, especially on the high yield end, you're going to get more for your money there. Is that more attractive to you right now?
I focus on Treasury rates and TIPS, but obviously corporate spreads have been coming in pretty significantly, and corporate issuers are coming in to take advantage of that.